Good to see you. And we were off to a rip-roaring start in June with the Russell, I think popping up 8% or something like that, but it's moderated somewhat lately.
Yes, that's right. And we have to remember where we came from. We had a very difficult year, obviously. Last year got off to a great start at the beginning of this year. And then in March, with the Silicon Valley Bank problems and the other bank issues and all the excitement over AI, generative AI, we saw a big move back into the large cap stocks, the traditional growth names. And as we know, when you look at the S&P, that's what's been driving the market. Interestingly, even in that environment, underneath the surface, we'd been seeing some green shoots of improvement in the breadth and the small cap sectors, and that really started to play out this month to date, driven by the fact that these companies are very well positioned for where the spending is going to happen, we believe, over the next 18 to 24 months. Specifically, the spending that's coming out of the government with the disbursement of the funds that have already been approved by Congress.
I'm so glad you mentioned this because we have massive fiscal stimulus at the same time that the Fed is trying to win the war on inflation, and the government doesn't seem to be playing along. Who's going to benefit?
So we think the economy is going to benefit. We think workers are going to benefit. We think the middle of the country is going to benefit. What won't benefit? Interest rates will stay higher than the market perhaps think they will today. But we are not too worried about that. Rates can be high as long as they're not going up dramatically. The market has digested the rates where they are today. Interestingly, the housing sector has digested where rates are today. Inflation may remain a little stickier as well, but it, in a sense, could be the good inflation, where we see workers changing jobs to get better wages, therefore having more spending power. But we don't see wage price spirals coming because it's not workers in the same jobs getting wage increases. And in fact, in addition, those wage increases are starting to moderate. So we think this bodes very well for, sluggish but continued economic growth.
You always have a couple of stocks in particular here. I see, Invent, Clean Harbors, air test systems. Do you think investors can do well, with the Russell 2000 broadly? Do they need to be stock pickers? And how long do you think this rally or outperformance that you foresee will last?
So we do think it's very important to be stock pickers here. And as we've said a few times before, we need that combination of growth and value in order to do well. You want companies that have tailwinds with spending. Again, we're looking at some of the infrastructure spend, some of the investment in the energy sector, investment in power grids, investment in data centers, which are going to get a big boost from generative AI as well as EVs. But we don't want to pay too much for that growth. In terms of the length of the rally here in small caps, we still believe that we are at the beginning of a multi-year cycle in small caps. We think this really is a generational opportunity like we saw in the 50s, in the 60s, in the 70s, in the 90s. We missed the 2010s. So we think this is a really interesting time to be looking at small caps.
All right. And like you said, it would be a good sign for the broader economy as well. Nancy, thanks for your time.